Hello, this is Paul Salazar at Hilton Hyland Real Estate, Beverly Hills. You are watching the buyer pre-approval process. This is meant for a first-time home buyer. This is meant for the buyer who hasn't purchased something in many years and they kind of want to get reacclaimed to the process. We also have Jack Gladden on from Priority Financial. Hi, Jack.
Hi, how are you?
Doing good. Thanks for joining. Jack's actually joined us a few times in some previous webinars. I sent a lot of business to Jack. He's a great mortgage broker here in Los Angeles. And so let me tell you a little bit about myself if you guys haven't seen any of my webinars in the past. I've been an agent at Hilton and Hyland for the last 11 years. I've been selling real estate for the last 14 years. I'm a SoCal native. I love what I do. If you're not familiar with Hilton and Hyland, we are a premier boutique luxury brokerage. So we sell a lot of the bigger estates in Los Angeles, including like the Playboy Mansion, the Candy Spelling Estate. Here's a little bit about Jack. Oh, there you go.
Oop. Yep. Hi. Thanks for the introduction there, Paul.
Yeah.
I've been in the business for about 10 years now, and I specialize I do loans all over the United States, but most of the loans happen to be in Los Angeles and Southern California. And I specialize in borrowers who've got complex tax returns and, kind of non-traditional income, but also everything else. So we can do loans from anything from about 100,000 all the way up to $10 million. And it's important when you're choosing a lender, especially if you're self-employed, to have someone who understands how to work with self-employed income. It's a totally different animal, and we'll get into that a little bit a little later in the process of this webinar as well.
Yeah, and like Jack mentioned, a lot of my clients here in Los Angeles, they're either business owners or they have just a very, very complex incomes, right? And so going to a direct lender like Wells Fargo, Bank of America isn't gonna be as easy, right? So that's where Jack comes in, and he really knows how to work with those types of buyers. But he also works with all kinds of buyers, W-2 buyers as well. So he's a great resource. If you guys have any questions, feel free to reach out to him. So let's get right into it. Again, this is really geared towards a first-time home buyer or somebody who hasn't bought in a long time and they really want to, understand, hey, I want to buy something, soon, and what's the process like? What kind of documentation do I have to provide? Can I qualify, right? So here on this slide, you'll see, some of the typical requirements to get a pre-approval from a bank. You got a proof of income, proof of assets, good credit, employment verification, and other documentation. Jack, why don't you kind of go point by point here and kind of discuss some of these documents in order to get a pre-approval?
Yeah, sure. So it's the two big differences that we find with borrowers where we differentiate is whether or not you're salaried or self-employed. So if you're salaried, it's a little more straightforward. All we typically need is the last 30 days of pay stubs to make sure to verify your income. And then if you're going to be in a jumbo loan, then we'll go ahead and ask for your tax returns as well. It's pretty quick and pretty easy when you're salaried. Everything's usually pretty straightforward. As far as assets go, if you're doing a conforming loan, so that's any loan that's in Los Angeles that's under $822,000. If you're doing a conforming loan, typically you won't be required to have any reserves. So that's money set aside in your bank account. But if you're going to do a jumbo loan, then reserves become more important, and different lenders require different things. So it'll typically be anywhere from 6 months of your total mortgage payment all the way up to 24 months, depending on what the program is and what the loan size is. So if the 24 months might be like a $3, $4, $5 million loan. They might want those sorts of things. If it's barely $800,000, it'll likely be 6 months, right? So those are the two big differences. So now if you're self-employed, the big thing is getting the most recent 2 years of your tax returns, as well as they'll take a look at your business bank statements the last 2 months, and they want to make sure that your business is active, and then there's deposits still going into your business. And if there's not, there's ways to go back a little further, but generally speaking, they want to make sure that there's business flow into your business bank account. So those are the two big differences. And if you're going to be doing if you're a self-employed borrower, it is very important to be working with someone who is not learning on the job and who knows what they're doing, because there's a lot of hazards with self-employed income, and you need to be working with someone who has kind of been around the block, because what you don't want to happen is that you get, 3 weeks into the deal and you're supposed to close, and then you get one of those super uncomfortable calls where, hey, we got a problem, we didn't account for X, Y, and Z, and now all of a sudden you need to bring in an extra $200,000 or we can't do the loan. And believe it or not, that happens all the time.
Yeah, it does. It does happen a lot. All right, great, sounds good. And in terms of proof of assets, is that only reserves, or are there other things that involve, what the underwriter looks in terms of assets?
Yeah, so the big thing is reserves, but also the down payment. So the big things underwriters are always looking for is to make sure that the funds being used for the transaction aren't a loan from somebody else. They're not a loan from your friend or from anyone that could be giving a loan. So that they look at the most recent 2 bank statements to make sure that the money's already been in there. It's not loaned or borrowed from anybody else. And then as long as it's not, and as long as there's no like super large deposits, then you're good to go. Now, if you have a deposit that's very large compared to what your regular deposits are, that's when we may ask for additional documentation to source it. So for instance, if you had like $100,000 deposit in your bank account and your normal salary is $10,000 a month, the underwriter is going to ask questions about what that is. And if you can provide, hey, I sold a bunch of stock and that's what this is, then it's fine. But if it's, oh, my friend wired $100,000 in my bank account, then that's going to create a big issue.
Well, I sold a $5 million house, so I got $100,000 commission. There you go.
Yeah. And so then we could source that and it wouldn't be a problem.
All right, sounds good. And we have here good credit. Obviously that's what is good credit? Like what are you guys looking for?
Yeah, so that's ranges dramatically. So if you're going to be in the conforming loan space, again, so in Southern California, that's an 822 loan amount or below. You can actually have credit down as low as about 620, which actually isn't very good credit. But if you're going to go into the jumbo space, you're typically going to need at least 700, more like 720 and above for most programs. And if you want those like really good rates, you're going to want to have 750 or above to do that. But so there's a range of options, and sometimes the program that we're going to put you in is dictated by what credit score you have, and sometimes we'll decide between lenders literally based on your credit score.
Okay, gotcha. And how much does the interest rate vary if your credit isn't as good?
Dramatically. So
Really?
so that's the biggest. That has the biggest impact of almost anything on what your interest rate is going to be, especially in the conforming space. You can see as much as a 1 or 1.5 point swing in the interest rate. So it's the number one thing. So it's a good idea, especially if you're getting pre-approved, but you're not in contract or anything yet, to really work on getting your credit score up if you can.
Yeah, no, for sure. I mean, I think if you're a buyer looking to buy in the next 6 to 12 months, it's always good to plan ahead, right? So if you are looking to buy in 6 months from now, talk to a lender now, or go. There's plenty of places where you can find your credit score. Talk to a lender, tell them what the credit score is. They'll let you know where you should be at, and then maybe you have to call a credit company that can help you with your credit score by paying off certain things or whatnot. All right, great. So let's move on to the next slide here: pre-qualification versus pre-approval. And the reason why this is important is because as a listing agent, right? If we get an offer from another agent and their buyer, and it's a pre-qualification letter, I usually if I'm having a discussion with the seller about this offer, I'm not going to feel very confident about this buyer, right? Because essentially, well, actually, Jack, why don't you talk about what a pre-qualification is, and then we can talk about what a pre-approval is.
Yeah, so to be perfectly honest, a pre-qualification almost isn't worth the paper that it's printed on. Just generally, it's all everything on a pre-qualification is stated. So you can literally just go online and say, yeah, I make $1 million a year, even though you make $50,000 a year, and just say a bunch of you can say a bunch of things and just get qualified, for basically any number you want. So people use pre-qualification as, if they're being honest, is kind of a guide of where they may fall, but it's not something that should be taken seriously at all, because they don't do anything, like they don't run your credit, they don't look at your income, your assets, anything. So it's really just a guess of what you might possibly be qualified for. Now, pre-approval, that's completely different. So pre-approval, you'll have your credit run. We'll get all your income and asset statements, make sure you have the required reserves and everything. So we almost are doing a upfront underwrite in a way, like a junior version of an underwrite. And when we issue that pre-approval, we have confidence that whatever number we say that you're approved for, you're actually going to be able to get the loan for that. So barring any surprises or anything. So generally speaking, pre-approvals, that's the real thing. You can take those to the bank. Pre-qualification, I would tell the person to go back and speak to a lender and get the real deal.
Yeah, because I mean, essentially a pre-qual is you go to the bank or you talk to a mortgage broker like yourself, and you just tell them exactly, what your income is and, what your credit is, but you may not, like the lender doesn't know the whole story until they see the actual documents in front of them. So, getting pre-approval is really, really important. Like, don't waste your time submitting an offer with the pre-qualification, because especially in this market, it's a seller's market, at least in most markets. You really want to come in with a strong offer with the pre-approval. And what I actually like and what I recommend is going a step further and getting what's called a TBD approval, right? Is that a TBD underwrite approval?
Yeah, and that'd be a TBD approval, TBD underwrite. That the terms are used kind of interchangeably. But so what that is so if you submit all of your documents, and so this takes extra time and work. So this is something you're going to need to do, a few weeks, if not a month in advance or something. But so basically, you take all of your documents, you submit everything as if you were actually in escrow on a property, and then we send it to an actual underwriter who will review all of your documents. So it's not me as the loan officer doing it anymore. Now it's an actual underwriter doing it. And then they'll sign off on it and say, yeah, we've got an approved loan. We just need to plug in the property address, do an appraisal, make sure the property's good. But as far as the borrower goes, they're underwritten, they're good to go. And so one of the benefits of doing something like that is then you could write in a very short loan contingency period, or even a no loan contingency when you're going up against an all cash offer. Generally when make you a lot stronger.
Yeah, and to Jack's point there, and I just want to reiterate what you just said is, especially right now in a seller's market, a lot of these properties are getting multiple offers, 4, 5, 6, 20 offers. I mean, I sold a property in Beverly Hills last year. We got 18 offers in 24 hours. It's crazy. So, if that is the case, you really want to put your best foot forward. And if you've already done your homework and you've listened to your agent, hopefully your agent, recommends this kind of approval, then you can be like an all cash buyer, right? Because you're not going to have a loan contingency. If you want to have an appraisal contingency, that's up to you. Consult with your agent. Obviously, if the agent feels that the house is priced well, then maybe you can remove that, right? Even all cash buyers, still have the box there for an appraisal contingency. But nonetheless, not having that loan contingency is so important, especially when going against all cash buyers, or even going against other buyers that are just pre-approved or pre-qualified, right? Because then, if you guys are all around the same price and you got one buyer that is, is a loan buyer but is already approved and doesn't have a loan contingency, that seller is going to say, what, this buyer looks a little bit better than the other ones just based off that one thing. And that, again, that just takes planning. It's not going to cost you any more, or it's not going to do anything. It's all about planning, right? Obviously,
exactly.
You don't know if you're going to find that house in that time frame, but talk to your agent, talk to your lender, start the process. That way, when you do find that house, that your family falls in love with, you don't lose out because you weren't planning ahead.
Exactly. Well
All
said.
right. So let's talk about closing costs, because I think this is really important. Obviously, a seller has their own closing costs, like paying the commissions for both the buyer's agent and the listing agent. A lot of buyers think that they have to pay for commission to their agent. That's not the case. The seller pays for that. But buyers also have their own closing costs, which include title fees, escrow fees, appraisal, and lender fees. So escrow fee, the seller and the buyer have to pay their own separate fee, right? And here is an example for like a $2 million purchase, right? This is, again, just a ballpark example. But what I recommend, if you're a buyer, talk to your agent, have them, get you an estimated closing statement, or ask your lender. I mean, I'm sure. Do you guys offer that, Jack,
Yeah.
as like a service for your buyers?
Yeah. Yeah, we do, and then we can coordinate with the escrow company or whoever you're thinking of using, and we can do it. So some people call it a net sheet, but well, that'd be yeah, we can get you an estimate on what those would be. Generally, though, the rule of thumb, especially at these higher price points, is going to be around 1% of the purchase price as your closing costs. If you're in a market where it's a little less expensive, then that could be as high as 2 or 3% of the purchase price, but SoCal about 1%.
Yeah,
just as
yeah.
a rule.
Yeah, for sure. So title insurance, if you're all cash buyer, you're not paying for title insurance. So that's one fee that you're going to have to pay for if you're going to get a loan. Obviously, the lender wants you to get your own policy. The seller has to get their own policy as well. We already talked about escrow fee and appraisal. How often does a buyer have to pay for 2 appraisals? Is that like a certain price range?
Yeah. So again, any of the conforming loans, you'll only ever have to get 1 appraisal. But so if you go into the jumbo loan, and it's literally goes investor by investor. So there's no like easy rule, but generally the more expensive the property goes, and I would say, starting with $1.5 million to $2 million loan amounts and above, you're going to see 2 appraisals be a lot more common. Anything below that, it's pretty common to just have 1 appraisal need to be done. So you'll want to look at that. And I've never seen anything required where you need 3. So it's just a
Gotcha. And what does the appraisal cost? How much does that cost?
Yeah, so it's a range. So on the low end, it'll be $500, and then it can be as much as on a really large, expansive property up to $1,200. And so that's going to go based off of generally the square footage and then the purchase price of the property. And then if it's a unique property, maybe there's 50 acres on it or something like that, then that could add costs as well.
Sure. Okay. Well, there's no 50 acres out here. Actually, I think there was one property that was on the market for like $1 billion. I think it was like a couple of years ago. I'm not sure if you recall. It was on like the Wall Street Journal and the LA Times, and it was a huge like promontory hill property for $1 billion. But anyway, I don't think they ever sold that.
I don't think so.
Okay, so
I think the guy went bankrupt.
Huh?
I think the guy went bankrupt who was in charge
Oh,
of that
really?
whole thing.
Yeah. All right. So, and then why don't you discuss lender fees, right? What are they paying for in lender fees? Is there like a certain percentage off the loan amount, or is it purchase price?
No, it's really the lender fees are a pretty minimal part of the whole transaction. So they'll differ from place to place, but generally speaking, it's about speaking of mine, which were right in the middle, I'd say it's about $595 for processing, $995 for underwriting. So you're looking at $1,500, $1,600 in those, and then you got your appraisal as well, and that's it. Now, some people choose to pay points in order to buy down their interest rates. So that's something you can do. Right now, rates are pretty low, so you're not seeing that as much unless it's an investment property where you're required to pay points. But you can, some people, so a point is 1% of the purchase, a point is 1% of the loan amount, right? So if you had $1 million loan amount, then 1 point would be $10,000. And it is a lot of money, but if you're going to be in that loan for a long time, sometimes it actually makes sense to do it. But again, right now with as low as rates have been, you're not seeing it as much.
Gotcha. Yeah, no, for sure. I mean, I think that's a good option and something that, as a buyer, discuss with your lender, ask him how much it costs to buy down the rate, how much you're going to save per month, and see, if you can live there for more than 2 years, and after 2 years, you're going to start saving money, then it's worth it, right? So it just all depends on how long you're going to live at the property in terms of, how much you're going to, want to buy down the rate.
Exactly.
All right. So I also want to discuss, besides closing costs, as the buyer, you're going to have to pay for inspections, right? So this is not part of the pre-approval or the lender, but this is also an important thing to kind of think about as the buyer. And depending on the house, and if it's a condo or if it's a small house or a big house, you can spend anywhere, between $1,000 up to $10,000 or even more, right? I mean, some of the bigger houses, these guys are spending $15,000, $20,000, but it's a $20 million house, right? So it's they got plenty of cash. It's not going to hurt them. But nonetheless, that's something as the buyer that you're going to have to pay for out of your pocket during the escrow process. Even if you don't like the property, even if you spend 5 or 10K on inspections and you find some serious issues and you say, you know what, I want to back out of the deal, that's still something that you have to pay for, and it's coming out of your pocket. All right, so let's talk about interviewing agents, right? Because this is also part of the pre-approval process, right? Not talking about the loan, but we're talking about picking the right agent to help you find your next home, right? So I always recommend interviewing, 2 or 3 agents. How do you find those agents, right? So many different ways. Everybody knows an agent, right? It doesn't mean that the agent is a good agent, because there's a lot of agents out there, and I would say the majority of agents out there aren't full time. At least the ones that are licensed, they're just not full time, right? I mean, they're closing 2 or 3 deals a year. That's not full time. I mean, you really want to have an agent who's working full time, because they're going to be able to help you navigate through some of the things that you're going to encounter, right? And the more experienced agent that you have on your side, the better equipped they're going to be able to challenge those, or to be able to help guide you through the process correctly, right? There's so many things that are being thrown at you, right? I had an experience just recently where we got the appraisal on a property, and it was a fixer, right? And the appraisal came in about $10,000 less than the purchase price. We were able to negotiate that with the seller, right? But then, what could happen in the future, right? Like this didn't happen in this instance, but what could happen if you're getting an appraisal on a fixer? The appraiser might say, before you close escrow, you're gonna have to put in, new toilets, a new kitchen. Like, I've seen a laundry list of items, and it's just like mind-boggling how an appraiser can really kill a deal. But just so you're aware, if you are a buyer that has a loan and you want to buy a fixer, you should be really concerned about how much of a fixer that you can buy, because lenders obviously do not want to be lending money on a home that needs a lot of work, right? So
Right.
just
So there can't be any. There can't be any what's called like health and safety violations. So generally that'll be, you can't have a leaky roof or signs that it's leaking. You can't have broken glass anywhere, like broken windows, that kind of thing. Peeling paints, things like that, that's okay. It has to have like actual floors in. Sometimes you see these places where like all the floors are torn out, so you need actual real floors. You got to have a working kitchen, working plumbing, all electricity, believe it or not. So those are the things. So if you are buying a fixer, just know that it can't be a complete fixer where you couldn't go in and live in it today. Like if you couldn't go in and live in it today, then it's not lendable with a traditional mortgage. You can get construction loans and fix and flip loans and things like that, and we offer those, but that's a whole different process, and those are a lot more expensive as well.
Yeah, for sure. Yeah, just and again, that has to do with hiring an agent to help you help you with the buying process, that has experience, that's gone through these things in their career. That way they know how to advise you correctly. Also, an agent who knows how to find off-market properties, because there's, I think, about 10% of properties are sold off-market. So you're losing on 10% of properties if you don't have an agent who's out there talking to agents, going through a list of expireds and cancels and lease properties that could be potential homes that are available for sale, but the seller, or the homeowner, doesn't want to put on the market for sale, right? For whatever reason it is, right? So always ask that agent, hey, how do you find off-market properties? I actually have a great webinar about how I help my clients find off-market properties. We talked about how many years they've been in the business, but also what area they work in, right? If you're looking to buy something in Beverly Hills and you have an agent who's a friend who lives in Orange County, that doesn't really make sense, right? You want somebody who knows the players, who knows the agents in Beverly Hills, knows the areas, knows the school district, knows a lot of these things, because you may not understand, like if you're living south of Wilshire or north of Wilshire or whatever it is, east or west of Doheny or whatever it is, you might not understand how that could affect value on the property unless you have somebody who's local who really understands the market. So that's really important. Ask about their offer strategies. Like I was telling Jack earlier, and how he mentioned, getting a TBD underwrite approval is super important. Most agents don't know that strategy, right? And don't understand how they can use that strategy and not have a loan contingency to help a buyer with a loan get an approved offer, from the seller if it's in a multiple situation. So always ask them, what are your offer strategies? Like, what should I do? Should I write a letter? Should I contact the seller on LinkedIn or Facebook or Instagram? Like I've had clients do that. They've asked me, it's like, hey, if you want to contact them, like I can't stop you. You might want to help yourself. I mean, that's up to them, right? Anything to set yourself apart, right, in a multiple offer situation, especially in a seller's market. Ask about buyer pitfalls to prepare for. I think we already talked about the appraisal issues. We talked about multiple offers, and also the biggest thing is inspections. I just had a listing right now that we had to take off the market because we were in escrow. The buyer came, with a laundry list of items. They actually canceled because there was too many things, too many issues. My clients, when they bought the house with a different agent, I was not their agent at the time. They didn't do all the inspections. They didn't do a sewer line inspection. They didn't do a foundation inspection or a roof inspection. They bought the house. It was livable, but now they're trying to sell it 4 or 5 years down the road. And the new buyer is saying, hey, like, what's going on with these issues? Like, you never saw, and they didn't even know about it, right? I mean, it's still livable, but most buyers don't want to be living in a house that has these issues, even if they can live in it at the time. But you have earthquakes, you have floods, you have all these issues that may not happen once every 5 years, but it could happen tomorrow. And then you just spent $1 million on a house or 2 million or whatever that is, and now you're left with a $300,000 bill to fix the foundation, or you got drainage issues, or your sewer line backed up and you got stuff all over, like sewage in your house. So there's all these inspections that you need to get done, and a lot of buyers don't know what those inspections are. That's why they have to hire the agent who has experience and knows what inspections to get for each individual property.
Yeah, and I would say that what you're saying right there, that's probably the most overlooked part of the real estate transaction, is what's the property going to be like when you go to sell it, right? And so people are like, oh, I can live with that, or I don't care, whatever. But it doesn't necessarily matter if it matters to you or not. It's going to matter whether it matters to the people you're trying to sell it to. And so to use Paul's example, I mean, a sewer line problem, which you could have paid $400 for the inspection, yep, could have uncovered a $50,000 problem because they have to trench and dig the sewer line out and repair it, do
yeah,
all those things, which you could have, one, got credit for that amount of money, or you could have had it fixed, but now the new people are actually requiring you to do it. Or fireplace chimney issues, foundation issues, I mean, those things can really add up big. So things like that, it's really important to be working with a good agent. I've seen it so many times when they work with someone completely new, they're kind of learning on the job, and there's some real hazards that come along with doing that. So just be careful. And just to go a little further with what Paul said too, is you would be surprised how many deals get done because the two agents know each other, right? And so if you've got a good reputation and you know the players in the area and everything, people say, oh, it's Paul Salazar. He's a really good agent. We like working with him. He gets it done. He doesn't just submit people who then, fall out of escrow. So we're going to accept this offer. And they could be two identical offers, but that little edge of having an agent that they know, that has a reputation they respect, things like that will get you the deal, believe it or not. And whether or not it's fair or not, it doesn't matter. That is actually how it works. So something like that, that makes an even bigger case for working with a seasoned agent.
Yeah, no, for sure, for sure. The inspection process is just it's a critical it's a thing. It just kind of think about like how much money you're spending nowadays, right? Because property values here in Los Angeles are just they're just it's so much, right? So any single family house you buy in LA is going to be at least $1 million nowadays, right? So if you think about an asset of $1 million, why don't you spend a couple $1,000s, very small percentage of that in inspections, even if you have to cancel the deal, but at least you know what you're buying, right? Because it will bite you in the butt later on when you try to sell the house, and you find out all these issues that you said, oh, I didn't inspect, I didn't think I needed that, I didn't really care, right? It's just good to know these things. Even if you don't care, it's good to know what the risks are involved in the future, right? In case you have to sell. Even to those buyers that say, oh, I'm going to live here for a long time, but it doesn't matter if you're going to live there for a long time, because you never know what life throws at you. I've had a lot of clients that say that they want to live here for a long time, and then 2 years later, hey, Paul, I want to sell because I've got a job transfer, or we want to change the kids want to go to a different school district, or whatever the reason is, right? Life happens. So it's always good just to have a savvy agent that's able to guide you, tell you what the risks are involved in buying in a certain area, or the value, or the inspections. All that stuff is super important. And also hiring a great lender, right? Somebody who's gonna get you a good deal, a good rate, who's gonna guide you through that process as well, because that's also another process, right? You have the loan process, and you also have the real estate, the house process with your agent. So.
Yeah, and there's a wide range of different options and different experience levels, even within the same company. So it's just be careful with those choices. Realtors and loan officers, although it seems like they're a commodity, I can promise you they're not, and experience really does matter.
Yeah, for sure, for sure. Jack, thanks for joining us for another webinar. I really appreciate it, man. Good luck with your business, and I'll see you next time.
Okay, thanks a lot. Talk to you soon.
See ya. Bye.